This is where trust will really come into its own again, I think, won't it? Because, to give that protection, it is the right place is to use a trust, I guess.
Yeah, and you're quite right. And whenever we advise clients on trusts, that is one of the first conversations is not actually the tax aspect, but it's the control, it's the practical aspect. The last thing anyone should be doing for any type of tax planning is letting the tax lead on the conversation. Because at the end of the day, we are talking about valuable assets and a business here. And what you don't want is for shares to go to the next generation and then potentially to fall into the wrong hands, for example. So the benefit of trusts in this scenario is that you basically pass on the value of the shares to the next generation, but you control what those shares. So you could be the trustee of that trust, and essentially you then have control all the voting rights that allocated to those shares. So basically nothing can happen with those shares without your say so. So that's the benefit of the trust from a practical point of view and from an asset protection point of view. As you also say, there are tax benefits, especially in this window here, where in the current proposal, the consultation document that came out, they have not suggested that there'll be any restriction on your BPR if you were to put shares into a trust before April 2026 when the IHT rules come in, the £1 million allowance comes in. So there is a window between now and then, unless of course something happens later this month in the budget. But apparently there's a window.
All things are subject to change.
Exactly. There is a window where actually you can put, let's say for argument's sake, £5 million worth of shares in the trading company into trust and suffer no IHT upfront. Now, what that does is it lets you get the money into the trust or the value into the trust. Clearly, if you were to die within 7 years, it comes back into charge as it would have done before for inheritance tax purposes. But what it does is it gets a certain chunk out of your estate, and it gives you a chance that if you do survive your 7 years, it falls out of your estate completely, that gift. And it's unlimited. And when you gift assets into trust, it's a disposable capital gains tax purposes, but you can get holdover relief for that when there's basically an IHT charge, which there is, but it's covered by the relief, the BPR relief.
Very interesting. Very interesting. Pension funds. We have found, particularly with smaller transactions, that some have, put money into their pension funds, particularly if there's been a lot of cash in the company as well. But now with the changes again, bringing pensions into IHT calculations from 2027, what's your thoughts about pensions? In terms of being tax efficient.
Yeah, I mean, as we referred to earlier in the conversation, it was quite a tricky change that was made, and I don't think necessarily one that people expected.
No.
The talk really around pension changes has in the past always been about tax relief on the way in rather than tax on the way out. So it did come as a surprise. And as you rightly say, to refresh people's understandings, now, where it's a post-budget, and basically for deaths after April 2026, money in your pension fund just forms part of your estate as though it was money in a bank account. So there's no IHT protection for that value. So that's one of the consequences of the change in the budget. However, what they haven't changed is something I referred to earlier, is the upfront income tax relief. So, ultimately what you are doing is growing a pot of money. That's what a pension is. And what you get is, 25% relief upfront straight away if you're a base rate taxpayer, and up to 45% if you're an additional rate taxpayer. So, the attraction to still put money into your pension is essentially tax-free roll-up. So you could look at it that way and say, from a purely investment point of view, why wouldn't you use the tax relief available to you?
Absolutely.
And so, yes, whilst at the end, there'll be inheritance tax if you leave it to the next generation. If your pension pot gets left to the next generation, in the meantime, you've built up tax-free growth, and all things being equal, you would hope if the investment performance is good, you probably won in the end overall, because in very basic terms, you're getting up to 45% tax relief, income tax relief on the way in, and the
Yeah.
maximum inheritance tax currently is 40% on the way out.
I think for anybody that wanting to put money aside to draw on in retirement, pensions, they tick the boxes. They really do.
Absolutely.
Um, the truth, though, is that quite a lot of high net worth individuals have tended to not need their pension. And it's been the thing that you touch last,
Mm-hmm.
because it is in such an IHT attractive wrapper, which that's completely undone now. So, I think it's going to change everybody's view in terms of, well, might as well just use it, get it out. Okay, I have to pay the tax. The good thing about it is there's no NI that needs to be paid when you take that out, but just literally enjoy it, because the double taxation, giving it to, let's say, to kids means that, for instance, there's a 40% IHT tax before then they've also got to pay their own marginal rate of tax to get the money out as well. It could be, I suppose, strictly speaking, like 80% tax that's being paid on a pension fund.
I think for people in that situation, there's still the attraction. The attraction to me for pensions is it actually does give flexibility, because you know whoever the pension is left to can choose to draw on as they wish, or not choose to not draw on. Equally, there could be some thought given to saying, well, actually, traditionally you would say I'll leave the pension pot to the next generation, but actually maybe there's a generation skipping avenue to take here. Maybe there'll be grandchildren or even great grandchildren in certain circumstances where you would
Yeah,
say, oh, actually, if I pass it to them, and by the time they draw on it, they might not have any income, then therefore there's no income tax um, on the way out for those people. As you say, I think pensions do still have a role, and I think that is the role. It's a pot. You get your sort of growth on the way in, income tax relief on the way in, and okay, you can manage on the way out what happens. So I still think they do have benefits. And the other reason why I suppose they're still relevant is you look at the other areas, other places you can put your money, and there isn't any other place that can be certainly IHT free. Yes, there are types of asset you can put your money in. So, one thing we haven't talked about is AIM listed shares. So whilst there are IHT changes there as well, again, they pre-budget attracted, full 100% BPR if they'd been held for at
yeah,
least 2 years. That relief has now been essentially scrapped, and now there's a 20% IHT rate for AIM listed shares, which is obviously clearly better than a 40% if it was still in your pension, a 40% if
yeah.
it was in your ISA. So, there's an asset mix you could look at. Um, but I think it's still part of, I think, consideration for any individual that's got money to invest to have pensions as part of the discussion. I don't think it's something you would just leave by the wayside now, because it does have its attraction still.
Yeah.